Big banks face billions in losses as risky loans plunge in value. I'm your host, Steven Van Metre, and thanks for joining me today. And seemingly hours after the Federal Reserve cleared the banks from their stress test to say that they can handle some of the biggest losses during a recession, well, we find out that the banks are sitting on billions in losses from risky loans. Investors wanted higher interest rates, and now they've got them. And with that, the banks seem like they could come crumbling down. Let's head over to Bloomberg, where we picked today's story up as Wall Street faces billion-dollar losses on sinking buyout debt, and lenders get a reality check on bumper deals as sentiment sours. Investment bankers in the U.S. and Europe are bracing for potentially billions of dollars in total losses on big-ticket leveraged buyouts as they struggle to offload risky corporate debt that's plunging in value amid a sweeping market sell-off. The biggest hit, which could amount to $1 billion, may come from the take private of Citrix Systems, Inc., which a group of lenders led by Bank of America, Credit Suisse, and Goldman Sachs signed in January. Each of the three lead banks could face losses in excess of $100 million, said people who asked not to be identified. With the Federal Reserve rushing to hike interest rates at the fastest pace in decades, credit risk premiums are surging far beyond levels banks had negotiated with private equity firms during the Halcyon days of cheap money. And there's kind of the story that we're finding out is banks made these deals and said, we're going to honor it at a certain rate. And now market rates have gone up much faster than anyone expected. And the banks have to sell off this debt at a higher rate, meaning they're the ones that are going to absorb the losses. And that is going to have a huge impact on future revenues and profits. Underwriters on both sides of the Atlantic are now sitting on an estimated $80 billion of commitments backing leveraged buyouts that will be difficult to sell in a market for junk debt that's effectively frozen. And while it's a modest undertaking compared to the more than $200 billion stockpile heading into the 2008 crisis, the worry is that write-downs will grow as rates rise, acting as a drag on earnings. And there's a second problem. You see, the markets are frozen. Nobody wants all this debt. And the banks thought they would just underwrite a ton of it, thinking the market would absorb it, or perhaps the Fed. And now with the Fed out of play and rates higher, nobody wants this stuff, meaning, as we just saw, the banks are going to have to write this down and eat the loss. The difference this time is the Fed is not going to bail anyone out, according to Richard Farley, a partner at Kramer Levin and Naftalis, who advises banks and direct lenders on buyout financing. Last week, Deutsche Bank showed its peers the scale of the problem as it sold high-yield bonds backing the buyout packaging firm of Intertape Polymer at just 82 cents on the dollar, one of the steepest discounts on a new junk bond issue in 2 decades. And discounts may not need as steep for companies that are perceived to be less sensitive to the economic cycle, and any reversal of market sentiment may ultimately lessen the pain for banks. But barring a surprise shift in credit conditions, losses could pile up quickly on deals that were underwritten at very favorable terms for borrowers in the case of Citrix. And when asked, representatives for Bank of America, Credit Suisse, and Goldman, well, as you can imagine, they declined to comment. And if you're concerned at all of what a blow-up in the banking sector could mean for your portfolio, well, you shouldn't be. I'll put a link up here in the corner to Portfolio Shield and the description below. Because now we get to the story behind the story, and that is that there's more problems for banks, particularly in the lending space, as rates go higher. And now JP Morgan lays off hundreds in home lending after rates surge. Our staffing decision this week was a result of cyclical changes in the mortgage market, according to JP Morgan. We were able to proactively move many impacted employees to new roles within the firm and are working to help the remaining affected employees find new employment within Chase and externally. Wells Fargo, the biggest mortgage lender among U.S. banks, has also been laying off and reassigning employees in its home lending division, according to people familiar with Wells. Earlier this month, companies including Compass, Inc. and Redfin, as we've covered, announced plans to trim their workforces amid the cooling U.S. housing market. Compass said in regulatory filings that will cut about 10% of its workforce, or about 450 employees, while Redfin plans to lay off 6%, amounting to roughly 470 workers. And all of this has to do with higher interest rates, and as banks originate fewer loans and have to write down some of these garbage loans that they wrote, well, it's going to have a huge impact on their profitability, which we'll find in the coming quarters, and that will have an impact on their stock prices and on the broad market. And this at a time when companies are now starting to pull back. It's not just the housing market that's laying off, but we're seeing some other parts of the economy start to pull back the reins on hiring. And more companies start to rescind job offers from this headline from the Wall Street Journal. As the labor market remains hot, yet businesses in a range of industries are pulling back job offers to recruits they were once courting just weeks ago. Companies including Twitter, Redfin, and Coinbase have rescinded offers in recent weeks. Employers in other parts of the economy are pulling offers too, including some insurance, retail marketing, consulting, and recruiting services. But these signs of caution in hiring show that executives are finding it tougher to predict the next 12 months in the economy, saying hiring managers and recruiters. When a company revokes a job offer, it indicates a company's business outlook has changed so quickly that it has to undo hiring plans it made sometimes weeks before. In an often case, it takes businesses months to make a hiring decision and then go through the process to actually hire someone, suggesting that what we've seen over the past 3 months is changing how CEOs and executives view the economy. And now from Bloomberg, recession-fearing bosses quietly abandon open jobs as growth in posting has slowed as late. Of course, we know this is what the Fed wants, fewer openings. They don't want to talk about a hiring freeze, but what they are doing is adding an extra layer of scrutiny, like saying only the CEO can approve these jobs. There is a stealth slowdown going on. More than 6 out of 10 CEOs expect a recession before end of next year in the region where their company primarily operates, and an additional 15% think a recession is already hit, according to a recent Conference Board survey of over 750 CEOs and other C-suite executives. Furthermore, the Federal Reserve raised interest rates last week, and that's going to have a huge impact on unemployment rate, as experts predict. And where does all this go? Well, it comes back to sentiment. And that's really, if we dig deep enough, you start to find what is the real story under the story? Is it higher interest rates? Is it companies pulling back their hiring plans? No, it's consumers not wanting to spend. And then when you have a pullback in spending on top of the Federal Reserve tightening monetary policy, well, things just don't go very well, and eventually things blow up. Perhaps this time it will be in the banking system. But let's take a look at the University of Michigan inflation expectations as they ease and sentiment hits an all-time low here, headlined by Zero Hedge, as while the headline sentiment reading from the University of Michigan survey made all the headlines, hitting a record low in preliminary June data. It was clear that Fed Chair Powell's later reflection on inflation expectations breakout that had the most of traders' attention focused in today's final print for June. A silver lining appeared as the 5 to 10-year inflation expectations dropped from the preliminary 3.3 to 3.1% final. And what we see is that current conditions have fallen, but future expectations rose a little bit, meaning consumers feel now that things can't get much worse. Well, I got news from many consumers. We're about to head into recession. You don't think things can get worse? They are. But what does all of this survey data mean? Well, it means things for the equity market are going to get worse, and interest rates should head lower. Let's take a look at these charts. We've got the University of Michigan Consumer Sentiment Survey in blue and against the Wilshire 5000 Price Index on a year-over-year rate of change. And as you can see, as the University of Michigan Sentiment Survey heads lower now, used to not lead as much as the market as it does now, but as sentiment leads, equity market follows. How about the bond market, where everyone's convinced rates must rise? Well, sentiment falls, yields too on a year-over-year rate of change. Now with the 30-year long bond here, 30-year interest rates, we see as sentiment falls, so too does interest rates. And it starts to make a lot of sense, because if you look at all these retailers and wholesalers that are going to be sitting on all this inventory, how would you clear it? I mean, how would you get rid of inventory if you're them? Well, sure, you can mark it down, but there's a limit as far as you can go. But what would help get rid of that inventory? Well, higher rates or lower rates. And now you start to see why interest rates fall during recessions. And how about these inflation expectations? What does that mean? Well, as they peak and start to roll over, it tells us that the peak perhaps in interest rates is here, and that the next direction for interest rates is to head lower. And along with that, it will head even much lower than most expect. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.